There's a couple of things that you have to know or lessons you need to learn about investing. Like for me, you always need to study somebody, go deep on that person. Like lately, I've been really focused on Warren Buffett. Warren Buffett, the Oracle of Omaha. Charlie Munger passed away. He has his, like they have, I think their market cap now is over $1 trillion, which is crazy because the majority of their stuff is not tech related. It's not the Mag 7. It's not Tesla. I mean, even though they have those shares inside of Berkshire Hathaway, but primarily the majority of his businesses are actually businesses as it relates to investments. But there's a couple of things as it relates to thinking about what the value prop, like when he talks about investments, and we all know what they are. I'll write them down. And I'll be quick about this because stay to the end of this video. It's very important that I go through this because if you're thinking about investing, it's important, right? So number one thing, this is what everybody remembers about Warren Buffett, right? Uh, don't lose money. That's number one, right? And that's pretty easy to understand, but I'm sharing these lessons with you because there's things that you have to know, especially if you're going to be investing in real estate. So the other one is you're going to be investing for cash flow. You need cash flow. Why? For Warren Buffett, it was like dividends. It has to pay something every month. A business has to pay something to its investors. So that cash flow from real estate, if you're investing, number one, don't lose money. Number two, it's cash flow because you need that drip. You need something coming in every month, every year, especially when you're in something long term, because it maintains one, the debt, all the expenses that go along with it, pays its investors, and it really it's confidence. It's confidence to all your investors. And then number three, it's long term. All right. Most people think short term when they think investing. They think stocks, trading, you're a trader. Like even if you listen to CNBC, when they're talking about investing, they're talking there's investors and there's traders. Traders go in, hedge fund guys, they have their metrics, they got their algorithms, they have all the different things that they're looking for, what's called alpha or profit. Like they're trading billions and billions of dollars, trillions of dollars like that. You can't do that. You're the little guy. Wall Street wasn't created for you anyways. But Warren Buffett, as it relates to investment rules, it's all long term. They didn't hit $1 trillion market cap by not thinking long term, right? Most of the stuff they own, he still owns Coca-Cola, still owns Geico. He's 98 years old, man. He must know something we don't. So most people with such a short-term thought is not thinking about investments. They're thinking about speculating. Why is that important? Because the things that you have to know when you're investing, because I took the same stuff when I think through investing in multifamily real estate, which is what I've done as an investment. So when you're thinking about investing, there's a couple of things you need to know based on that information with Warren Buffett's rules, right? So one, you need to know if you're going to, before you invest in real estate, what is your exit? That's important, right? So even though we talking about long term and how he's held stuff forever, you still need to know how you're going to exit because you got to have some strategies. Who's your buyer? Who is it? Is it a mom and pop? Like when we look at stuff, it's owned by institutions, it's owned by companies. So I know the companies that I'm looking at, the owners, they own billions of dollars worth of real estate, not hundreds of millions of dollars, billions of dollars of assets that they have under management. So when I'm looking at who owns it, I'm also looking at who's going to buy it from us, right? Or are we going to go back to the bank? What are the returns going to be when we exit? Because the returns we get based on the performance of the properties that I'm looking at when we're running numbers and like, okay, what is the new upside in value? What's the new upside in rent? Can we hit our future returns? Why? Because I need to know that because I also need to know when we exit, who the buyer is going to be. What are their returns going to be for their investors? What do they want? Because JP Morgan that goes in to buy a portfolio or Blackstone or BlackRock or EQR or Avalon Bay, they have investors. Even though they're a REIT, they got to hit certain returns. You need to know what your returns are, and then later when you sell, what are their returns going to need to be for their investors? That's how you structure your deals. You got to know. You can't just guess. So you have to learn this stuff. And then when are you going to do it? Is it 7 years? Is it 10 years? Are you going to reset your debt for another 10 years and be in the deal for 20? Like I said, these guys hold deals he's 98 years old, man. He's been buying stuff since he was like 12 and 10 years old. No one's going to beat that. Now, can the deals you look at last that long? If it's a 1960s 10-unit deal in the middle of nowhere that nobody wants, and do you think you're going to have it forever? Probably not. So you need to know when you're going to exit, and can your deal even sustain the level of exit that you need, you or your investors, or if you're going to invest with somebody like me, can it even happen based on Warren Buffett's rules? Long term, right? Cash flow, and don't lose money, right? You could lose money if you exit too soon. You could lose money if you exit too early. You could lose money if you can't hit your returns, or you could lose money if the people that you need to sell to exit the deal can't hit their returns. They're not going to buy, right? So you're going to have to sell at a discount. All of that matters. And who is it? That's why I said there's things that you have, those lessons you have to learn so you know what you're doing before you make an investment, right? All this is important. Go back to something so you see it. Who are your partners? And when I'm talking about partners now, I'm talking about your debt partners. Who's the bank? Who's your financial partners? Like for us, the deals we look at, because of the size of those deals, are probably going to be Fannie Mae. Well, not probably. They're Fannie Mae. They're going to be Freddie Mac. They're going to be a life insurance company. Like some of the biggest debt people on the planet, companies, institutions, wealthy companies fund big multifamily real estate deals. Why? Because it's a stable return on investments. Period. Right? So you got to know that. What's their appetite? Like, where do they want to invest? Fannie Mae and Freddie Mac, they're based on different criteria, right? So they may not like the deal that you're looking at. If the deal's too small, they won't touch it. If they don't also have an appetite for the market that you're in, they may love San Diego, but not like certain areas in San Diego. We don't want that. Or they may have already hit their markers for what's called appetite in the market. Let's say it's in Austin. They go, look, we don't have an appetite for Austin, but inside of Austin, we like Round Rock. You need to know what your debt partners expect. What are the terms they're going to tell you? Maybe the terms aren't good. Maybe they'll say, we'll give you 5 years of interest only. Got to know that. And after 5 years, it switches over to principal and interest. And you need to know that too. Can you live with those terms? Right? That's another point and a half over and above, not like if you're going to do the principal and interest too complicated. You need to know that your partner's expectations are already set. And if you're going to use them as a partner, do you have the same expectations for you and your investors? Or if you're investing with a guy like me, what our appetite is for the debt and bringing on partners. So you got to know what your partner's expectations are as it relates to your lenders and your debt people. Next, the returns. You got to know what the returns are. Long term, like we said earlier in this one, what are the rules? Long term. What are the returns? Most people try to calculate their return short term. They're thinking this month, they're thinking next month, they're thinking, oh, I got to get my, like, that's not real. So it goes right back to partners. So let's say you're an investor in a deal. All of our deals, all of our terms on all of our funds are 7 to 10 years long, with my ability to continue to extend, right? That's important as an investor to know that, hey, I'm dealing with a guy that, one, I'm extremely conservative. Extremely conservative. I don't want to lose. And I know that if I have the ability to continue going on, like I said here, if this is like last year and the year before last were terrible times, they couldn't hit investor returns, but they had to sell, right? So when you're looking at any deal, you need to know 100% before you invest, like, hey, my returns are going to be spread out over long term. I'm not calculating for next month, next year, even 5 years. Sometimes, hey, just push it all the way out 10 years, 7 years. What happens if we had to stay in the deal? Do we still love it? Right? Very important to know that. That's how you don't lose money. When you think about those things, when you know, you already have a lesson about those things. And next, the market. You need to know your market. I just did a video on need to know the market. I went over all the stuff about the market. The markets went inside of the markets, the demographics, how much do the homes sell for? What are the tenants paying? What's the percentage of their gross income in relation to the actual rent? Is it 27%? Is it 30%? If we bump rent in the property, the percentage is going to go up, right? But did their income go up? Will their income continue to go up? Are they high paid professionals or not? Like, you need to know all this stuff, and this has everything to do with the market, not just the asset you're investing in, but your basically your customers, your tenants. So when we're looking at that, we have to know all of these things to hit all of these investment criteria rules that, like Warren Buffett talks about: don't lose money, cash flow, and is it a long-term stay in the deal investment? And then the other one we look at, and this is talking about real estate now, right? Is multiple units. A lot of people like to look at investing in a single family house. And if you take a look at, like, hey, can you exit a single family house? Yeah, you can, depending on what's going on. But just recently they couldn't. How does the debt feel about that, which is your biggest partner in the deal? if you're only doing a house, single family house, as an investment, I'm not talking about living in it, they didn't want to lend you money. Their terms are terrible, right? Can you get a return? Not really. If you have to put down 20% down on $1 million house, that's $200,000. That's not including your 6% commissions, your 3% for closing costs, whatever it is that you have to bring to the table, 1% a year on your 1% to 2% a year, depending on where you're at for your property taxes, and probably God knows what your insurance is going to be, not including all your maintenance costs. There's so much more that needs to happen when you think about, oh, I'm going to buy a house and it's going to be a great investment. There's better investments out there for you to do. How? Multiple units. Even, which goes right back. I'm going to go through this T chart. But Warren Buffett, they didn't do like single stuff. They didn't buy one share of Coca-Cola. They bought multiple shares of Coca-Cola as an investment. They knew they were going all in on this one thing, which brings me to this. Oh, man. This is the difference. I love this part. This one. And I've been talking about this. This is different because this is a program. This is a wealth program. This is very different from the program most people run. And I wanted to do this in the T chart for this part. I think this is important to kind of see the difference. Wealthy people, we'll just use Warren Buffett. We'll say Warren Buffett, Elon Musk, Jeff Bezos. Like, just watch what these people do. Don't listen to what they say on videos because it's different. Watch what they do. Right? They're talking to the media, but if you look at their business, we'll use Warren. They'll pay, I think one of his quotes is, it's better to pay a fair price for a great company than a great price for like an unfair company, whatever. Basically, don't lowball. But what do the average person try to do on any investment deal? They want to lowball on property. They want to lowball on a property. They want to buy a business at like basement prices and then expect that investment to be great, right? That's not how it works. The other wealthy people, what do? They think long term. They think 10, 20, 50 years out. Japanese companies have a 100-year horizon. That's crazy, but that's real. Warren Buffett, he had a 100-year horizon. He's 98. He's been investing since he was like 6, 7, 10 years old. Think about that. Charlie Munger just passed away. He was in his 90s. They were partners. They had a long-term horizon. They're still holding shares of companies that they bought when they were young. That's the difference. And you look at everyone now, the average investor that trades on the stock market right now are in and out of a deal in less than 2 years, 3 years tops. And if you're a day trader, you're in and out of those deals in minutes. Just random people. They're not thinking about wealth, but that's what everybody's taught, right? You're a middle class millionaire. You don't have access to a lot of stuff. You're not thinking long term. You're thinking short term, right? You're not even playing that game. Different program. You've bought it. That's the game you're playing, very different. But wealthy people are doing something different. They take big positions in deals, right? Warren Buffett, big position in Coca-Cola, big position in Geico, big position in Bank of America, which he just sold off. And he sold off those big positions in like Apple, Bank of America, and everything. And what did he buy a big position in? The Treasury bill. He owns more, I want to say it's like the bonds. He owns more bonds than anyone else. Berkshire Hathaway does. Big positions. Every time they play the game, they're not playing the game the way that like little people take a little bit of everything, diversify your investments. They're not doing that. They're doing little most people are doing little deals, little opportunities, a little bit here, a little bit there, a little bit there, because Wall Street teaches you to do that. But the people who are actually the titans of Wall Street, the titans of investments, they're not doing that. You're doing that. So next, these guys are paying no taxes. Warren Buffett doesn't pay taxes. Why? He doesn't have earned income that way. Elon Musk sold a bunch of shares of Tesla to do what? Pay taxes. But you look back now, why did he really sell? He paid taxes because he was actually in negotiations and he bought out Twitter, which is now X. Crazy, right? These guys don't pay taxes because if you don't sell the shares of your company, it's not earned income. It doesn't target that. So they just keep these things keep constantly going. If they sell, they trade, they go back into their own companies. They're not paying big taxes. What do you pay? The highest taxes possible. Why? Because you were sold a different program. Get in, stay short. Don't make that much money. And oh, by the way, we're going to hit you with 40% taxes. If you're a baller, if you're not a baller, we're going to hit you with, let's say, 19, 20% taxes, which is still not that much taxes, but you have no write-offs, right? We're talking about investing in real estate. At least if you take a big position in a institutional size deal, 200 units or above, you get the tax benefits, depreciation, all those things passed through to you as an investor, which is the way we do it. And then now you're not paying any taxes on the passive income that you did receive, right? I didn't even write dividends up there. All these guys are looking for dividends. Next, They all have partners and investors, and they use debt. Amazon, tons of debt. They have a bunch of cash sitting off to the side. If they want to acquire something, they go get debt. They don't use their cash. Apple sitting on a bunch of big cash accounts. I want to say, I think Berkshire Hathaway, I just read an article that I think there's like $300 billion cash sitting, waiting, ready to go. Now, when they went to go buy something, what they use? They didn't use their own cash. They used debt. They got things financed. They go to the debt partners, they go to the debt market and they finance it. They keep their cash. This is a whole different game. Other people are like, don't get debt, pay off all your debt, don't do all that stuff. That is not the game. All right. So when you look at it over here on this other T chart, who does it? They don't have any partners, right? The other program don't have partners, man. They're all bad. Not true. They use their own money. Don't use anybody else's money. It's all bad. Not true. Then they run out of money and they can't play. So they don't have partners. They won't get a bunch of partners. These guys have hundreds of thousands of investors. These people, I made this mistake too. I had like one or two. And then when I didn't have a bunch of partners, I couldn't take advantage of deals. They were using their own money. I wasn't constantly going off and getting more partners, and I wasn't going off to get more debt. And then naturally, they have bad terms on their debt. They use private money lenders, they use hard money lenders, they use all of these other resources because most of the time their deals are too small or the deals are too shitty. And a real lender, a conventional bank like Fannie Mae, Freddie Mac, or a life insurance company or something, won't fund those deals. So they gotta go to a local bank, regional bank, national bank, and then those banks put bad terms on them and they can't actually play the game because they got a noose around their neck. Like you need to look at what the wealthy people are doing. They are not doing that. They're not, right? Matter of fact, local banks are actually partnering on their deals on the equity side while they go get the bigger lenders in bigger debt. So next, they take advantage of don't lose, can't lose opportunities in the marketplace. When I say don't lose, can't lose opportunities, for example, Coca-Cola, that's a don't lose, can't lose opportunity, right? For Warren Buffett. When he bought into Geico, that was a don't lose, can't lose opportunity. He was watching Geico grow and expand and change with technology. People weren't doing, they were just like, oh yeah, this is the insurance guy. They were actually one-on-one, going out, meeting people, doing stuff. They were changing the industry. That was a don't lose, can't lose opportunity at the time, right? Treasury bills, the T-bonds, the all that stuff. Don't lose, can't lose opportunity. Why? That's fixed income investments. He bought it cheap as he bought these things knowing that rates were going to change. If the treasury bills drop, he makes a shit ton of money. Long time ago, I think he came in and saved one of the big banks. I can't remember whether it was Goldman Sachs or yeah, it was probably Goldman Sachs or one of them. He gave them a lot of money. It was a don't lose, can't lose opportunity. I think they paid him 10% on his money guaranteed, and he had to get his money back for a certain amount of time, and he took a bunch of their stock. He's a baller, man. Trust me. Even though Warren Buffett looks like your grandpa, he's a gangster. But in your side, there is no don't lose, can't lose opportunity for you. It's all lose, must lose opportunities. Because why? You guys want to speculate and gamble. You're buying something that doesn't make sense and you're hoping to speculate. Now, that's fine if you're trying to make money, but we're talking about investing money that you've already made, taking your earned income and you're investing it in something that one, you're getting a good deal on a great opportunity. It's going to be long term. You're going to take big position, right? But naturally, your big position, like some of the stuff I'm looking at, I want to take a big position, 100 units, 200 units, 300 units in a market where there's not a lot of supply and demand. There's not a lot of 100, 200 unit deals trading. That's what I'm looking at. That's a wealthy play. I'm just trying to do what Warren Buffett says to do. Next, we don't want to pay taxes. We want to buy something and then write it all off and then spread that out to our investors so they don't have to pay taxes either. That's the goal. I want to have hundreds of partners with my debt guys, my investors, all of those people. That's the game here. The more people, the better. It's actually a hedge against problems. The more investors you have in the deal, the less problems that you're going to have as it relates to lawsuits and a bunch of other stuff. It really is a hedge. And then last but not least, I want to be in don't lose, can't lose opportunities. Like some of the deals we're looking at are owned by institutions and like institutional real estate companies, not mom and pops, not dentists and doctors and lawyers and stuff like that. Actual institutions, banks own these deals, right? Or they're invested in them. They're not making mistakes. They're not going to lose their investors' money. They're not going to lose CalPERS, the California pension funds money. They're not going to lose the pension fund money for the firemen of Florida. They're not losing. So if you're able to get access to those deals, which the average person's not, right? If you can invest your money in a deal like that, that is a massive opportunity. Now, if you're just going to grab some lot someplace and throw up a couple of multifamily units or build a house or buy some Section 8 property and hope that things work out for you, great, go do that. But that don't call that wealth. Call that making money speculating. And if you win, great, win. Take your money off of the table, just like going to Vegas. You win, take your money, cash your chips out and leave, and then you go use that money on something that continues to pay you, and then you go gamble again with something else. But you don't keep doing that. That's not how you create wealth. That's how you create mistakes. And you'll multiply mistakes if you're not crazy. Multiply money, not mistakes. Big deal. So that when I drew this T chart out and I was like, hey, these guys are willing to pay a good price for a good deal. They're not lowballing people. Like, think of the difference. Think about it. Do you do this? Which side do you play on the most? As an investor, investing money, do you invest good opportunities long term? Are you investing in deals as a part of a group? Let's say you were a passive investor with a bunch of other investors. Are you guys taking a big position in a deal, or is it like a little shitty small property? It's a couple of duplexes on a lot. You guys are going to put an ADU in the back, or are you going after an institutional quality deal, right? And you guys are all taking a big position in an institutional quality deal, not a small one. Are you guys forced to be like, hey, fine, you might not be paying taxes, but you might not be making that much money? Is there only 5 or 6 guys in there? Is the debt okay? Is it like, oh, it's a regional bank, they like it, blah, 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 they like us in this relationship? It's going to be a relationship, but you got to be aware of those things. And is it a don't lose, can't lose opportunity? Or are you playing this side of it? That's the program you're running. The middle class, the middle income millionaire thing. Let's lowball. Let's beat people up on the price. Let's beat people up on the terms. Let's think about let's be in and out of this thing in 12 months, 13 months. Let's see if we can just rape somebody, see if that works. Let's keep it small, keep it tight. Let's do a little deal. We don't need all that. We're gonna probably pay a lot of money in taxes, or we're gonna cheat the game and lie, say we didn't make any money, but you really did. Yeah, you don't have any partners. And if you do, it's just you and your friends. I was doing this stuff. This is me. A little while ago. I stopped doing that. I don't want to do this anymore. I know better. Right? Well, as soon as I finally saw the light and I did good on a deal, I was like, oh, I'll never do that again. I was doing this, I just didn't know, but I was doing more of this on purpose. Right. And then I was like, are you just speculating? Ah, my guy, he likes it, man. It's a vacant lot. They're gonna build, they know what they're doing. I like them. I'm just gonna give them my money. We're not gonna get any money for our 3 years, and they told us we're going to get 57% return on our money. Like, dude, it just sounds like something's going to go wrong. Warren Buffett's not doing that. They're not looking for that. And if he's winning, you might want to listen to him. So anyways, this went long, didn't want it to go long, but it was the first time I went over this T-chart because I thought it was interesting because when I wrote this down, even for myself, I was like, dude, what side of the table do you want to sit on? You want to sit on this side? This is the program. We're all running a program anyways. We're all taught something. You want to sit on this side of the table with this program, or you want to sit on this side? This side does win too, but you can't do this long term. This side wins long term on purpose. This side wins long term and short term by guessing. You want to take the guesswork out of your investments. So that's what I'm doing, which is why I created Bell Capital. I wanted to actually help people who didn't want to guess anymore, who don't want to do the work, to be able to invest in deals. I go find the deals, we fund the deals, we manage the deals, and we write you a check. That's what my goal is. And I want to do that long term with great properties, great locations, with everyday people like you. So you can do this with you and your family, because I want to grow a company, a big business that continues to buy billions of dollars worth of real estate and takes care of my family, your family, and takes care of people for a long time. I think that's a challenge. That's a problem. Most of the deals we look at don't deal with regular people like us. Like, it doesn't deal with the Victors and the Sharons and the Michaels of the world, or none of that stuff. They just deal with like the super wealthy. I'm not talking about super wealthy people. I'm talking about super wealthy institutions, the BlackRocks, the Blackstones, the EQRs, the State Street, the money managers, the big asset managers of the world. That's the wealthy I'm talking about. I'm not talking about people. So we can do their deals, man. I can put together a portfolio big enough to go back and present it to them. And if I do that, we all win. That's the goal of Bell Capital. So I want to do that with you. If you want to do it with me, go to bell-capital.com. Take a look at what we got. You can schedule a call, or you can register on the site and you can take a look at the documentation. You can see our fees, documents, how it works. You got to be accredited. You got to have a good attitude. You got to love real estate, and you got to want to invest long term. and you got to be patient, right? So look, and if not, leave me a comment. I always answer comments. If you have questions about what I said, great. Like this video, share the video, comment on the video. I always read the comments. Subscribe to the channel. I appreciate you guys for taking the time, but I make this so that way you get an idea of who I am, why I'm doing what I'm doing, why we're doing what we're doing over at Bell Capital, and we want you, I mean, totally transparent. I want you to invest with me, period. And I'm not doing this randomly for videos. I'm not an influencer. My goal is to share information so you understand how I think. All right. Hopefully it resonates with you guys. So look, have a great day. Let's get after it. Let's go.